For Dukascopy TV, I'm Alex Isa with this edition of the Weekly Wrap-Up. Joining me for a review of the past week is deVere Group's Tom Elliott. Tom, tell me what you think was the main market mover this week.
The main market mover is probably the downgrade to US GDP for the first quarter, down to minus 2.9% an annualized rate. And it's significant for two things. First of all, because it does highlight that you can have this quite substantial downgrade and it still doesn't move the market as much as you would think. So in a way, this was the non-event of the week. And it's important because it illustrates the complacency of the market, illustrated also by the VIX, which makes me very nervous of being overweight risk. A second reason why it's important is it highlights yet again the peril of macro investors in trying to link changes in GDP to share prices through the middle part being corporate earnings. There seems very little immediate relationship.
Now, focusing on the UK, Mark Carney has been described as an unreliable boyfriend, which seems to have had an impact on sterling. Do you agree that he is appearing more hawkish?
Mark Carney realizes, as every central banker does, that zero or virtually zero interest rates cannot be a permanent feature of the monetary landscape, because it leaves you absolutely nothing for the next time the economy weakens. Therefore, he is under pressure to raise rates to a normal level. This doesn't make him hawkish, it just makes him sensible. And in so much as the US under Yellen appears to be continuing on a very low interest rate path indefinitely, inevitably that has led to a slight rally in sterling in recent weeks. And I expect that to continue. In fact, I'm not ruling out 175 US to sterling sometime over the next 6 months.
Do you feel there is cause for concern for the UK's economic growth?
Yes, the main cause for concern is the fact that wages aren't growing at the same speed as consumer spending, and it's consumer spending that is driving the economic growth to the 3.1% year-on-year growth that we saw in the first quarter. So that means people are either dipping into savings or borrowing more. Either way, it looks horribly like a rerun of the early noughties that led to the financial meltdown. People taking on too much debt and not having enough buffer of a savings. And incidentally, the same process appears to be taking place in the US. What we really need to see is an increase in business spending on investment that would then drive profits and growth in the future.
Everyone is looking to the east as the Iraq dispute is rumbling on. Do you think the conflict will have a long-term effect on the markets?
I don't think it will. And this isn't just because the Iraqi government is currently claiming that next month we'll see an acceleration of oil output. I think that's largely irrelevant. The market has long priced in the Sunni-Shia tension that's driving all these problems in the Middle East, and also has begun discounting a fall in long-term oil prices as shale and fracking gas take off in Western economies. And I think over the long term, you're actually going to see the Middle East decline as a destabilizing force on energy prices.
And finally, what do you think our viewers should keep an eye out for next week?
Well, next week, two big things from the US. We've got the ISM survey on Tuesday, which is likely to see manufacturing continuing to grow at a fairly nice pace. And then on Thursday, usually it's Friday, but it's bank holiday, it's public holiday on Friday, we've got the June non-farm payrolls, which is always a big day for the markets. And I think if we can maintain above 200,000, then it'll be further evidence that the Q1 negative growth was a one-off caused by the weather. I'm actually quite confident over the underlying strength of the US economy.
Thank you, Tom. For more in-depth analysis of what's making the financial news this week, be sure to check in with Dukascopy TV. Goodbye for now.